See, it's just gone on 10 o'clock. Morning to all of those participants that are on the call already. It's great to have you with us. We've got almost more than 400 people that have signed up for the webinar. So we're just gonna give a little bit more time for some more participants to join. So we'll just wait a little bit longer. Morning to everyone that's saying good morning in the chat box. Right, I think we'll kick off. We will be recording the session, so the latecomers can watch it when they're ready. Right, good morning, and thanks so much for taking the time to join us. Like I said, it's great to be able to chat to you again. There's a lot been happening in the markets, and it's great to have Rob Spanjaard, who's our Chief Investment Officer and co-PM, with us today, and Simon Sylvester, who's also co-PM with Rob and Head of Research. My name's Plessis. I'm Head of Distribution. It's great to be here with you. I suppose just some house rules. House rules, it sounds quite formal. We will be recording this session, and at the end of the session, we'll be sending a link to the recording, as well as a link to the slide deck. And then I know CPD points are sort of a formality. We will be sending out certificates as well for the CPD points. We have asked for an hour of your time today, and I think a lot of you are familiar with sort of our format and how we go about doing this. So what we'll do is there is the Q&A box at the bottom of your screen. Simon will be manning the questions. So please, and you know, he might not answer it immediately because there's a relevant part of the presentation where we'll be talking to that particular question. But what we'll do is we'll chat for an hour, and then at the end, you're welcome to, if you have to leave, you're welcome to leave. But then we do sort of have our sort of coffee chat at the end. Hopefully next year we can get back to seeing you in person. It will be awesome to see you all around the country, and we look forward to that. And with that, I think let's move on to the agenda. So we've just put together a little agenda, just a preview of what we'd like to share with you today. Rob's going to be talking to the business update. There's some interesting things that have been happening at Rezco, exciting developments. And I suppose what's also important is a recap of what we've been calling for this year. What have we said? Has it panned out? How are we positioned? How do we see the markets going forward? And then, of course, the big one, inflation. Everyone's talking about it. Is it permanent? Is it transitory? And we've got some awesome slides and thoughts on that we'd like to share with you today. And then Simon's also going to be talking to the fund performance. I'm sure a lot of you are aware that our multi-asset funds have struggled over the last 12 months. Our equity fund, on the other hand, has done exceptionally well. Simon will talk to you what sort of contributed to performance and what's detracted. And even more importantly, going forward, how are the funds positioned and where do we see the opportunities? And then, like I said, we'll have the extended Q&A or the coffee chat afterwards. And please feel free to pose your questions. If we don't get to your questions, please email us and we'll respond accordingly. So with that, I think I'll hand over the plane for Rob to fly the plane. Over to you, Rob.
Brian, thank you very much. just starting, we'll get on to a little bit of business update, not much there, not much changing, but just reiterating what he said on the questions. We don't want to ever come across that we know all the answers. We like to think we've thought of a lot of the questions, but we definitely don't even know all the questions. So it's great when we always like the counter view, and internally part of our process, we try to understand what all the questions are in the market, the big market questions. And it's a great forum here, getting some of these questions, and we deliberately leave it that it can extend past the 11 o'clock, because we find it's just great just chatting, and feel free to drop off when you're sick of hearing us talk, but really appreciate your insights and those great questions. So again, just like quickly, not much has changed here. We're still working hard on being BEE level 2 by the end of the year. That's well in progress. That's, I know, very important in a lot of our counterparties' businesses, certainly something we take seriously. The core management of the business, that nothing's changed at the senior level. At the team, we've got a great team. We've got some younger people who obviously exceptional talent. We've got some senior people who've joined us, which was John, which been for us more than a year. The metals and mining's part of our portfolio is really doing incredibly well. The team's in a great place. Obviously, as an investment team, you never like a period of underperformance in your multi-asset funds, but the core machinery of the investment team's cooking, and you can see that in our equity funds. In the Rezco equity fund, a lot of calls we've got to make, a lot of research, a lot of digging through the dirt and talking to companies and trying to find those opportunities. And on a risk-adjusted basis, it's on 3 year, I don't think there's anyone even close to us. And it takes a great team that Simon and I have got. Obviously, we've got operations holding it all together and helping us operate a fairly low cost structure, which is important in our world. Client base is nice and stable. That's the breakdown of the funds. Mostly our clients know why they use us, and no one ever likes a period of underperformance, but mostly we on our, as I said, equity funds been pumping, or balance funds really on a macro call. It's been taken time to get there. We think we're right. I think we're happy to always change our view, but we think it's bearing out, and we'll obviously talk around it. But we really, mostly our clients really understand why they're using us. It's this really low correlation. So if you've got 4 balance funds, don't have them all performing the same, and we fit that counter view. We're right often when the guys are dead wrong, and sometimes we're going to be the opposite direction. Not that we're contrarian, but we prepare to call it as we see it. And fortunately, in our relationship with our clients, we've got this 16, 17-year track record, so they're happy to give us time to be right. And that's important. So we really just appreciate the solidity. And the one thing which we resonates with a lot of our clients is you find a really good manager who's had a bad year, and that's actually when you put money in. And there's a lot of truth in that. We always like to take money when we've absolutely smashed it, and you do tend to, but it's we have periods of underperformance, and it's actually a brilliant time to put money into our balance funds, because there are reasons for it. So that's why it's important to us. Guys might say, why are you talking about equity fund? Equity fund goes to the expertise. The investment team is absolutely cooking. Our macro calls, we think we're right. We've just been a bit early on it, but we'll get a bit into that without talking the whole presentation on the first slide. This was a great article that was put out by Jeremy Grantham. We spoke at it, I think it was in our February presentation. My goodness, that seems a long time ago. Waiting for the last dance, and he was really just comparing at a late stage of major asset bubble. And in this case, it was the 2000, the dot-com bubble. It was patently obvious with hindsight, yet everybody stayed in. They stayed for the last dance, and when you stay for the last dance, you can't leave. And it's a great article because there's a lot of pain in it. You've got to, now obviously we would like to be right a week after we made, and we certainly try to do the timing right. What surprised us now is the Fed have just ridden the horse to the death. We certainly educated, eminent people have been calling inflation, and the Fed, for whatever reasons, it's just not. And their view has been it's transitory. Now they've changed their mind. Now they're saying, well, we were surprised by inflation, and so was everybody else. That's not really if you look at the record. But this is a great article to read because it details a pain trade, and that you can do two things once you're in a pain trade. You just capitulate. Obviously we always look at the facts. We dig in. Are we being silly, having so low equity exposure, such low equity exposure, being so what we do have, being so defensive, which actually loses a little bit of money when the markets keep going, and we'd happily change it. But the point is for us is the facts that have been coming out have been enhancing our view. So that's why we've been prepared to be patient. But if you haven't read that article of Grantham's, it's worth reading because he details it. And so what we say to the client is, look, you've ridden a bit of pain as a Rezco client this last year. Now, in fact, you should be adding to this position. We've got a small allocation to Rezco balance funds. Now's when you should be adding it, because if you see the markets the last couple of weeks, it's turning. The reality is starting to dawn onto the investment markets. Okay, so what were these realities? We had this slide at the beginning of the year, and we had a couple of analogies, and this is taking Jamie Dimon of JP Morgan, chairman, that had written out, they'd given 3 alternatives. Now, these are our pictures. They're not Mr. Dimon's pictures, but the principles are the same. It's Goldilocks. Everything's just happy, low 0% interest rates, pumping quantitative easing, no inflation, just that's not happening, because inflation is happening. So Goldilocks a fairy story that can't happen if ultimately you get inflation. Coronavirus was a particular worry. It's still at the beginning of the year. Would the variants like Delta override the vaccines? We know the answer to that, largely not. And then you had this last option, which was inflation. And this picture we put in, this is our picture of crash test dummies, driving a car, drinking a coffee, smoking a cigarette, is taking a lot of risk. However you want to do it in a market completely unprepared for it. Now, other analogies have been used by Mohammed El-Area and a couple of people. It's like you're going down a mountain pass, but the driver still has their foot flat on the accelerator. Now, what we mean by foot flat on the accelerator, monetary stimulus, interest rates at 0, with inflation, so negative real interest rates of short term about 4%, which is massively stimulatory in any environment. Quantitative easing, it's going on a monthly run rate of $120 billion a month in the US, Europe doing QE as well. So you're going in an environment, you're running a 15% budget deficit, which is some of the biggest since the Second World War. So you've got an economy that's pumping and you're still on maximum stimulus. So we're saying, look, there is a bit of there's a disconnect on that. And that's not just us saying it, it's like you should at best be neutral. Neutral would be 2% interest rates, no QE, and and not a fiscal stimulatory deficit. So we got this map. This is our mind map. And before you leave the presentation, I'm going to go through this picture. Simon put it up. It's part of our research process. We think about like what happens, what if, but it leaves you. I'll give you the distilled version of it. Just showing we think the counter view. We like I was saying earlier, we always coming from the view, where on earth are we wrong? And we read, we go and we read the Fed papers. You go and that you've got to be committed to investments to go and read Fed research papers in detail and their internal researchers, PhDs, what are they saying? Because it's an ecosystem. You dig in, are we missing something here? And anyway, we drill it down to two options. And the simplicity of that, we're happy if anyone wants to go through our total process and are thinking we'd love to do it, but it really comes down to option 1 and option 2 and TINA. And I'll make the point why I don't think TINA is really a great option. It's not really an option. But we think the net effect you're going to get in 2 places. Interest rates normalize, But that means P's come down, the market gets cheaper. So you've got economic growth, but the market, so increasing interest rates, there's a strong correlation between that and the market gets cheaper. The earnings yield of the market goes up with the interest rates. So that's highly likely. Means equities go up a little bit. So you've got strong economic growth, but you give a lot of this company earnings growth back via the P's fall. So you don't really get much equity growth, and then bonds obviously get killed. Excuse me. The option 2 on it is you get inflation, the toxic, we call it toxic, monetary tightening recession. So there's a great article, funny enough, Jamie Dimon, that I was reading yesterday from about a week ago, a week or two ago, he was talking about, look, there's a chance the Fed are going to get behind on this. Not definite, they might, but you can't always assume the Fed's ahead of the curve. They might be behind the curve, in which case they're going to slam on the brakes, which is going to be nasty. But if you get inflation, monetary tightening, recession, you get an equity bear market, and you take bonds take a hit. So this is actually, funny enough, what's playing out. So we're getting the Fed are stopping QE. They haven't stopped it yet, but they're just been signaling that they're stopping it. You can see since then, we've got a graph later on shows how the equity markets have rolled over, and the bond yields have started going up. In other words, the prices have started falling. TINA is an interesting one, so TINA, what we think is Goldilocks' cousin. Interest rates stay close to zero and no inflation. Monster big budget deficits funded by QE, very strong economic growth, and equity valuations. The valuations go up from record levels. Now, we would postulate that it doesn't work like that. You can't keep interest rates at zero if you've got a pumping economy, because it's dependent on very strong economic growth. So there's no logical economic formula to keep interest rates at zero with strong economic growth. And inflation miraculously will not be there. We'll make our case why we think we should be concerned about what's coming down the line. So the market is positioned at the moment, slides we've mentioned before, incredibly bullishly. The market's expensive. Just highlighting something, that's the S&P, and this is the forward PE of the S&P. You can see it's an expensive market, comparable to the 2000 bull market, the dot-com bubble, and also we're well into a massive bull market. Now a lot of people in the investment industry, this is all they remember. In other words, equity, day trader, what we spoke about last year, equity markets only go up. They can never go down. We would say that's dangerous to believe that. You've also been in a bond bull market. This is since 1990. This is 20-year bonds, and that's the price. It's your index, how much money you've made on bonds. But the problem that there's a ceiling here, which is called zero. Your interest rates can't really get, bond rates can't really get much lower in the year. So at the end of a massive bull market, bonds are pretty expensive, and equities. So we think the market's wrong-footed. It's positioned for Goldilocks economies. In other words, everything because it's a behavioral thing, and that we spent a lot of time thinking about our behavioral biases in markets. And we look at our own. Are we just too bearish? Are we bearish type of people? Should you take some Prozac and cheer up and join the party? But it leads us to a bit of a thinking that the market, as investors, as markets, you just look what happened most recently, and that becomes, you make that a law that will always predict the future. And we think the market, because it's kind of worked, and we've been well into this largesse, the market is positioned for Goldilocks economies, economics. Everything just carries on perfectly. But here's the problem: the shares are priced for perfection. If the shares were bombed out, then absolutely you would be the risk reward. But the shares are priced for this. So if this is wrong, you position badly. That you can carry negative real interest rates for indefinitely, and inflation is impossible. Reasonable inflation, I would say, it doesn't have to go back to 10%. but some degree of inflation. And this is the point why Goldilocks is we think not going to work. And why Tina's got a problem, because some of the thinking is that inflation is not impacted by employment or unemployment levels. It's not impacted by economic slack. It's not impacted by QE. It's not impacted by negative real interest rates. The only and most important thing that affects future inflation is inflation expectations. So you see quite a bit of this coming through in some of the Fed thinking, is that, like that quote of Powell's, and we reference it a bit later, of saying, look, we've been surprised by the inflation, the 1-year inflation, but we're definitely thinking expectations are anchored, and therefore we're happy. And there's some degree of theoretical economics that's locked onto that. But part of the problem is we haven't had inflation for the last 20 years. So expectations, it's easy to just say every inflation can never be there because it hasn't been there for the last 20 years. But we're getting a little bit into this, why inflation expectations, even on that, are becoming unanchored. So in short, the Tina train, like a lot of we don't listen to our competitors' presentations because we're not trying to copy them. But we get the feedback from clients who just says, like, Tina, what's the option? You don't have a lot of equities in your fund, but I just want to own equities, or clients want equities because of Tina. And it's don't fight the Fed, always buy the dips, markets always go up, ignore the risks, and QE is always available should anything go wrong. Okay, we think it's dangerous because even not just on the first point of don't fight the Fed has swung. They've stopped. You can see as soon as it's announced they're going to stop doing a QE, stop QE at the end of the year, the markets have rolled over. So it shows you what's propping it up. That's without them having to tighten more aggressively than the market thinks. Another part of team is buy the dips. So there's a couple of rules of economics you're talking about there. Don't fight the Fed, but always buy the dip. Let's wait for a fall, and you can see this on the Russell. As it gets down to this 2150 kind of level, you buy it. It's almost a rule of economics. And that's starting to break down. I'll show you that a bit later. So what we're saying, what can go wrong here? Inflation, the Fed are positioned for deflation. All their policies, their massive stimulus, is our biggest concern in life is deflation. And we think it's changed. I'll talk a little bit about that. So further, so there's inflation come up. There's a bit of an energy crisis, which is a bit of a problem. The coal prices, oil prices coming through. There's supply chain bottlenecks. Now, these aren't opening up problems. These are just you can't keep up with increased demand. It's not a COVID lockdown opening up thing. It's way different to that. Stockouts are rippling through just-in-time delivery networks. So that's JRT there. We built this incredible. The consultants charged a huge amount of money on this, of pushing, absolute optimize, never carry any stock of parts, and you get everything absolutely optimized. Something slightly goes wrong, it messes up the whole system. The massive budget deficits. So politically, if you look particularly in the US, they've fallen in love with this ridiculously big budget deficit. So just what I was saying earlier, a budget deficit the same size as just Second World War, close to those sort of, it's not quite as big, but it's like the biggest since. And why? Because it's sort of a liberal agenda, and it's not a problem because you can just print the money. But if that one piece of that equation is disappearing because of inflation starting to pick up, that's why they're talking, well, we've got to stop the QE. Now tied to that, who are the bond buyers once the central bank step back? So once the Fed stops buying the US government's budget deficit, who buys it? Then you've got something else that you're going to worry a little bit about is Chinese property debt crisis. There's elements of the Chinese accounting that sort of feel a bit Steinoffy, and it works until it stops working, and someone's got to add up the score, how much bad debt there's in China. That's just going to keep you worried in the back of your mind, because a knock on from there, that's not a prime worry at the moment, but just keep thinking about it.
Just to jump in, just to jump in quickly with a question. It's someone's anonymously asked, do you think the Fed is more likely to revert to QE in the future compared to their willingness to use QE pre-2008, since there have not been major consequences for it? I think it's a good question. There's two nice angles to kind of respond to that question. Firstly, just the pre-2008 versus now. Obviously, in 2008, it was kind of a bit of an experiment. And now it's seen that, okay, the experiment worked. It's a little bit linked to the TINA trade. So Rob had a slide there, just ignore the risks because we've got the solution, right? So there's no future crisis that can't be resolved because we've got the solution and it's QE. And I think what's dangerous in that is if the next crisis is an inflation kind of bond crisis, an absent buyer for government bonds, who wants to fund the deficit, if that's the next crisis, the medicine we have of QE is not going to work for that. In fact, it'll make it worse. It might prolong it or delay it, but it would certainly make the structural risks a lot worse. So I think we've got to be careful in this idea that ignore the risks, just buy the dips, equities always go up. We've got the solution. The other side of that coin is we've got the solution, it's QE. We can use it now, it doesn't cause inflation. Doesn't matter what crisis happens, we use QE. I don't think that that's correct because it does have implications.
Can I give another analogy? The QE, so QE prior to 2008 was something used in exceptional circumstances. In 2008, they did a bit of QE, but with they were scared of this thing. And you did a little bit. Most of the QE, in fact, went back into the Fed because you did QE, but then you increased the bank reserves. So we've got some graphs and some previous presentations of that. See, most of the QE was because they forced the big banks to keep more cash at the Fed because they didn't want a banking crisis ever again. So most of the QE went back to the Fed. Okay, so here's the thing: they used a little bit of QE, and now the sort of feelings, oh, this is a great new toy. We have governments don't have to be disciplined because you can just do what you want. So the analogy is you had a nice little glass of scotch, a nice tot of scotch, and it was great. It didn't have an impact. And then you took the bottle and now you've decided to down it. It's the amount that you're doing that is a problem, and everything else you've done. Because they've done massive QE that's going into the real system. They've done helicopter money, which is never really been done before. You sent everyone a check in the post. At the same time, throwing a massive budget deficit. So it's the adding up of all these things and still not keeping interest rates at zero.
Yeah, and someone just quickly asked us just to clarify for everyone. QE, we're talking about quantitative easing, and that's where the Fed, the central bank, prints money and buys US Treasuries with it, and then so it funds the government effectively the budget deficit. And TINA, there's no alternative. It's basically this idea of, well, if interest rates are zero, there's a lot of cash. You just have to buy risk assets. That's all that will protect you in this environment. You've got to own assets. The problem we have, though, obviously, is the price you pay for that asset can fall. And so in that case, you'd rather have cash and not lose money.
No, sorry about the jargon, guys. We live in these acronyms, but it's important. So any questions, feel free. Apologize if we start throwing jargon around. It's the world we live in. So it's a massively expensive market. A way of looking at it is EV/EBITDA, which is a way of measuring how expensive shares are, but includes the amount of debt they got. You can see the blue line there. The forward PE is slightly lower than that slide we had up earlier, the 2000 boom. But on an EV/EBITDA measure, which is a measure that's quite well, there's some esoteric. We use it a lot in the finance industry. It shows the market is actually much more expensive than it was in 2000 on some measures. So it's a massively expensive market. And this is excluding tech. We strip, because you might say, look, you can't include tech in 2000 because it was a dot-com bubble. So even stripping that out, it's a massively expensive market. We're well above COVID levels, pre-COVID levels, sorry. It's an expensive, our market's expensive. Our mining shares are cheap. But we think that party's ending, so we've actually reduced the mining exposure quite a bit. Our SA Inc. shares, so my apologies, are not cheap. If you believe the South African economy is about to take off, then they're fair priced. If you believe we're still grinding along a recession, then local shares are actually getting fairly expensive. And some of this is an interesting graph we put out. This is total return indexed to 100. That's the South African All Share Index in blue, or in fact, it's actually the capped circuit version of it. And then the Russell 2000, the Russell's US speculative US smaller shares. So you can see a very interesting correlation there. And now this is two totally different economies, different companies. I don't think there's one company that overlaps. So it might be an interesting question. Someone might find some corner case it does, but I think there's no overlap. And you can see the link. There's a horribly close correlation. And that just shows the degree that even our market has just been trading on sentiment. So the Russell's very sentiment driven, and we're trading like a small cap index. It's the next 2,000 shares, smaller shares. So you can see that these all these turning points. This is just our market moving on sentiment. We must be careful of that because we start to, certainly in South Africa, our economy has still got a bit of stuff to struggle through. Okay, coming back to, why is inflation a problem? Why is like, guys, you're just always talking about this darn inflation. I'm sick of it now, would be a fair comment from clients. We think it's very important, it's fundamental, because this QE, this printing of money, where government doesn't have to tax anyone, they don't have to borrow the money, they just print the money out of thin air. That it means that ends, that QE ends. You can't do it. You can't have interest rates lower than the inflation rate. And if there is some degree of inflation, and we're talking 10%, we're just talking inflation comfortably above 2%, rising yields are bad for asset prices. And interest rates will lower economic growth. And there's also, there's another case on it with the risk of stagflation. More and more people are talking about stagflation. We have inflation and no growth. Now that's probably your worst scenario for equity markets. That's a massive bear market, and that there's a real risk of that. So in it, beginning of the year, it was sort of a bit less common to be forecasting inflation. Counter view, but you can see this inflation's appeared. That's core consumer price inflation. Inflation is there. That's the most inflation this year since the early 90s. Germany just had the worst inflation for 35 years. But there's always an argument, with the secondhand cars, we're a big impact of that. So we strip out some of the stuff. This is core. Whether it's you take out food, shelter, energy, used cars out of the inflation numbers. This is US inflation numbers. So whereas this had kicked up to 4%, this kicks up to 3%. Because used cars were a big thing. They went up massively. But there's stuff that hasn't come through yet that is still going to come through, which we'll talk a little bit later on, particularly around shelter, which is 40% of core CPI. So we get in this interesting thing that the Fed is forecasting 2.3% inflation next year. That's higher than their target of 2%, but they can sort of live with it. They're saying, well, and it's mostly because they're saying inflation expectations are well anchored. Now, we're talking a little about Lael Brainard, is the San Francisco Fed governor. She's trying to get Powell's job. So if you look at Elizabeth Warren coming out, senior US politician, look, I don't support Jerome Powell. The liberal wing of the Democratic Party, Powell's term ends this year. Powell wants to keep his job. He's a very wealthy individual. He doesn't want to go and write a book or something. He wants his job. So he's forcing to be more liberal. But Lael Brainard is content and putting pressure on Powell. That's why it's very relevant what she's saying. So she's saying, I expect inflation to decelerate and pre-COVID inflation dynamics to return. Just for some reason, everything's going to go back to pre-COVID. The current elevated level of inflation is driven by COVID-related disruptions. As these disruptions disappear, inflation disappears. Now, this is bizarre at the extreme, and we'll tell you why. The inflation picture has changed. So the first thing is labor rights, political pressure for real wage growth. There's environmental costs for increasing inflation. You see this particularly in energy prices. So if we see it in our industry, some asset management won't invest in coal companies. We will not own a coal company. We're happy to, because we take the full ESG picture very seriously, and we believe in South Africa got a lot of coal mine people who go down the mine, and we can't just stick them on the street. But some big pension funds won't touch a coal share. Some banks won't lend to coal mines. So you can see it's going to end out in the coal price, and the greening of the economy is going to cause inflation, making everyone trying to get zero emission. That doesn't come free. You've got supply chain bottlenecks. These are because of the massive increase in demand by what you've done in the stimulus, particularly in the US. If you talk to the shipping companies, they say 2-3 years before that comes right. It's not that a factory was closed because of COVID. It's just because demand is too high. That's what the shipping companies say. You've got deglobalization and protectionism. So where before it was make everything in China, was a tremendous deflationary force for about 25, 30 years. Now companies are saying, oh my gosh, we better not make everything in China, because China could, there could be, there's trade tensions between the West and China. And then this last bit I was just touching on a bit, demand is greater than supply. And bottlenecks are not bottlenecks, it's actually shortages, which take a while to come right. So the Fed, it's an interesting thing here. This is one of our previous webinar that, this is Jerome Powell, back to old Jerome. The challenge we confront is how to react to this inflation, which is larger than we had expected or anyone expected. Now, there's a lot of people who are telling them they're going to get inflation. And to the extent it's temporary, it wouldn't be appropriate to react to it. But here's the problem. It's all around, is it transitory? Is it temporary? You can see the Fed's accepting now that it's not, and we need to stop the QE quite quickly. And there's a concern even there that they're slightly behind the curve. That's why they've now said QE is going to end in the next couple of months, and you'll see the impact on the markets. But it's around this thing, is it temporary? Now, if the Fed was saying we couldn't forecast inflation over 1 year, but please believe us, there's going to be no future inflation. And that's where the market is saying, we're not that sure. If you couldn't forecast it over 1 year, how are you going to forecast it over 3 years? And so part of their thing is that you're saying that, look, if inflation is expectations are well anchored. There's a bit of inflation this year, but who cares? Everyone thinks it's going back to 2% next year. So this is US consumer inflation expectations. Always run slightly above actual inflation, but the trend is what is important. This is consumers thinking inflation in 1 year's time, what's it going to be? So they're expecting 5.2. And here's the point. In 3 years' time, we expect inflation to be 4%, which is high. It's like over the time of the survey, it's really, really kicking up, and it's also the direction. So what's the Fed's response? And this is Mel Brainard again, and this is 27th of September. This is the liberal wing of the Fed trying to get the top job. There's an interesting tussle there. So what you do is you look at your 1 year inflation expectation and say, yeah, it's kicked up. And look at the median. We don't want to take the average. Look at the median because it suits us. You can see how that's gone from 2.9 to 3.2 to 4.8. And then quietly just move to the 5 year inflation. Now, obviously what moves first is your first 1 year, then your 3 year, then your 5 year, then your 10 year. And so just conveniently ignored everything and just said, look, we ignore the 1 year and the 3 year, and it's just long-term inflation is not a worry. And and there's a very detailed article we were going to put in the presentation, but Simon had a whole lot of research on one of her recent speeches, what she's saying, and then going down and looking at the actual facts. And it's bizarre. It's scary how political it is. We thought, look, you guys are going to, too many people will think, wow, it just sounds like an economics discussion. But believe us when you can say it's got political, because there's a belief in the liberal wing or the progressive wing of the Democratic Party is that if we let the economy run really, really hot, it forces labor rates up. And the bottom end, the poor people do well. Now, that's an eminently noble sentiment, which one would agree with if it worked. But what's happening is the Donald Trump, who's doing the best out of this market? It's the Donald Trump type people, property developers. So property and people with asset-rich people. So people who live off their paycheck are getting shafted by the system. You rent a house, which is a lot of people in the US. Rent a house. The people who own the house and own equity portfolios are laughing. So even progressives are starting to say, why on earth are we doing this? So here's professional forecasters, and you can see the impact. That's at 21 inflation, that's at 2022 inflation, and this is 2023 inflation. So this is a Reuters survey of professional forecasters, that's going up. The Fed to be saying, look, it's all well anchored is just not borne out by the facts. And here's an interesting article. We spend a lot of time, because this is what we do. We, bizarrely enough, a lot of you must think, why on earth do we do this? We find it really interesting. You go in and read. The Fed is not a dictatorship. It's thinkers. Ultimately, the guys at the top just make a call. What do their own researchers say? There's a very interesting article by Jeremy Rudd, who's a senior researcher at the Fed, saying, guys, don't bet the house on inflation expectations. Just a point here. A review of the relevant theoretical and empirical literature suggests that this belief rests on extremely shaky foundations. This concept of that only thing that counts is future of inflation expectations. And a case is made that adhering to it uncritically could easily lead to serious policy errors. It's very detailed, PhD, wonky, utterly boring, unless you find this stuff interesting, article on at the Fed by the Fed's own research. Guys, don't bet the house on this inflation expectations. So it shows a shift in the thinking. And here's another way before I get too lost in it. That's change in the Case-Shiller price index, and you can lose Zillow index, any of the house price indexes. And this is the CPI of owner's equivalent rent, and the CPI of primary residence. Now, combination of this translating into core CPI, so what we're saying is 40% of core CPI. And interesting one, even in the Fed's thinking, there was a fascinating paper put out about a month ago by the Dallas Fed's researchers, PhD. There were senior researchers of the Dallas Fed who were talking about exactly this relationship. Saying, whoa, hang on, guys, this is going to come through because house prices lead, and there's about an 18-month, there's an 80-month lag. You can see we shifted it 18 months. We shifted the red line that way 18 months. So this is about to pump. And that's 40% of core CPI. So that's the Fed's own research. Dallas Fed, which is the Fed's work sort of regionally, saying, guys, we have a bit of a problem here. So you can see the thinking, even in the Fed, is, oh my gosh, this might be difficult. So when you've got house prices going up 20% a year in the US, and it's 40% of core CPI, it hasn't moved yet. You can bet a lot of money. Now, it's not going to cause, it kicks up to, from the 2% to probably 5%, 6% levels, but that's going to translate massively through to inflation. So fine for Jerome Powell to say, look at secondhand cars, and it's not really sustainable. But this is the big mama on inflation, and it's coming through hard. In an environment where labor's tighter, this is job openings, the yellow line, job openings at 11 million. Companies can't find anyone to do the job. This is unemployment, but concern is a lot of people have left the labor market. People getting close to 50s, 60s, the equity prices have pumped, their houses prices are going up. They don't want to work anymore. And you can see the quit rate is another thing that the Fed looks at closely. If you only quit your job if you think you're going to find another one easily. And this shows a very, very tight labor market. And we wanted just a little case study on how you see this inflation trends go through the market. And then if you can bear with us, it's just like an interesting, it's just part of the picture. It's not the whole picture, but it's really fascinating. So US goods demand went up 25%. What the goods make. Well, I mean, what the goods consumed in the US, stuff. China's where they make the goods. You can see China electricity kicks the China electricity demand. It has a linkage to coal prices, gas prices, container traffic prices, and the result's a major output gap. And the goods are obviously only part of it. You've also got wages and housing. So here's the core of why this thing's not transitory. This is US demand, expenditure on good. goods, on stuff, so that was running on trend at about 4.5 trillion. And then they did helicopter money. They sent everyone a check in the post, and goods demand has gone up to 5.5 trillion. And the economy's pumping. Everyone's got lots of money, unused debt that isn't coming down fast. So even when you stopped sending stimulus checks, it stayed at these levels. So you've added, this is the biggest economy in the world. You've pushed up the demand for stuff by 20%, about 22%. Okay, so what is the impact of that? China is where you make the stuff. And you can see China electricity demand is like, take the 2-year number from here, that was 2019. You can see how Chinese electricity demand has jumped a couple of percentage points above trend. They've had a little bit of a hydroelectric water shortage, but it's small. If you look at the power produced by hydro, it's down slightly, a little bit of a drought. The biggest problem on this is that they've now had to, they've actually been short of power and actually been switching the power off of it. So they've had some Chinese version of load shedding. Oh, sorry. So you can see the impact of, we want more stuff. You've got to make this stuff, use more electricity. Then you get this thing of China, China, it was the FT article, demands energy supplies to factories, keep working at all costs. So they just buy at any price. So what do you see the gas price do? This is European gas prices, natural gas prices. You're talking about a ridiculous 10-fold increase on the yellow line, natural gas prices going from 5 to 200, 5 to 80. Coal price, even the same thing on the coal prices. Coal price going from $50, that's this axis, $50 a ton to 200. Because China just trying to buy every bit of coal. There's talk of the UK running out of gas, and this is going into the European winter. Now you have these sort of massive increases in gas, coal. Oil's gone up a lot, not nearly as much as this. It causes inflationary pressures. Another little one, silicon, 300% surge. That's used a lot in metals. A little bit of it goes into chips. But this is not the full inflation picture. I'm just trying to show how you get these knock-ons. Now, this is interesting on container traffic. So because you've created all this extra stuff, now it's got to get to China. So to send a container to China has gone up from $2,000 to $15,000. If you talk to the shipping companies, so it ain't coming right for another 2 years at least. The interesting line here, this is what it costs to send a container from the US or from Europe to China. You can see that hasn't really moved by much, up a little bit. It's from China to Europe, and this is from Europe to somewhere else. But look, that's sending stuff out of China. So you've created huge demand, and the Europeans also buying more stuff. You can see how the knock-on effects of these things. Now, that's not COVID opening up. That's because you're just using more stuff. It is a very wonky economics thing called an output gap, where your economy is running above potential. So the calculated, and there's a lot of leeway, absolutely, how you can calculate this thing, but we believe it's correct, and clever economists than us have done it. That you've got an output gap of almost 4% by the end of next year. In other words, the economy is growing too fast for the availability of goods, labor, commodities, and that's going to be inflation. That's massively inflationary, and only because demand is going up quicker than supply. And the only way that supply is going to catch demand is if you slow demand down. And that's called a recession. That's normally why central banks tap the brakes. So one of the problems is another problem on it is you have this inflation. That's the amount of the US issuance, the US outstanding treasuries that the Fed has bought, that red line over there, because of QE. So they've gone from 13% of the US treasuries owned by the Fed from the previous QE, they've pushed that up to 23. So they've been the big net buyer. So when they stopped doing QE because of inflation, you can see the last year they bought 70% of the US budget deficit. Who buys? So the Dems still want to run a massive budget deficit. who's going to buy it, which is why we think bond rates are going to go up. I'm going to pass the mic a bit to Simon to do this section.
Thanks, Rob. Yeah, so I'm just going to go through some performance slides with you, but please feel free to send through questions. We've tried to cover the questions we've been getting from advisors, but obviously ask the questions as you see them. Just to zoom out a bit, and you would have heard us saying this quite a lot, risk management's not market timing. And when you zoom out, a lot of these kinds of risk events and periods of outperformance and underperformance kind of all blends into each other. We don't really remember them, blow by blow. But the reality is, it's our longest running fund as the value trend fund. The reality is there's been periods of exceptional outperformance, but there've also been periods where the fund's underperformed for quite some time. And we're willing to take it, we're willing to kind of manage risk through these periods. And the thing about risk management is it's not an exact science. It's not a perfect probabilities. You're dealing with a risk could happen, but it might not. And the timing is always difficult. That's why we talk about this risk management process and not a market timing process. And so I think the context of the last year, if you go to the next slide, when you kind of zoom in on the performance, you can see the underperformance is clear there. This is value trend versus peers. And you can see the 1 year performance, the underperformance there. Obviously a bit of context, coming through COVID, the performance was really good, but in this kind of year since, there's been this excessive stimulus that we think was unnecessary. We've been conscious of the risks. We've been staying out of the markets, and the markets obviously shot up quite a lot, and therefore we've underperformed. But I'll break that down a little bit. We've got a waterfall chart here, which breaks it down in quite a nice way, which hopefully highlights the areas we need to talk about. So obviously we've got our local equity on the left there, which is the return generated from our local stock picks on the JSE. Fixed income's the interest we're getting off our bonds. So those are the big additions. The fund also invests, you'll see the Z class, so the zero fee class of the equity fund, so that you add the two together to get the total local equity, just shown it separately there. So what have been the detractors that's added? Now, you could argue, you could look at those numbers, that's added too little in a bull market, right? So markets, it's absolutely pumped. You generally want those to be bigger, but we've stayed out of the market. I've got some more data coming up. But the big detractors you can see on the right-hand side, Rezco Global Flexible Fund and the currency contribution. Now, currency, we know is obviously the Rand has strengthened. Now, we know that the Rand will weaken in a risk-off environment. Doesn't matter what's happening in South Africa, really. In a risk-off environment, the Rand generally weakens, and we've been calling a big risk-off type environment, and therefore we've been positioned for Rand weakness, but we've got Rand strength. And that's why you see that big currency contribution. But we know the Rand is volatile. We can see it's weakening now in a bit of a risk-off period. But that explains the Rand. But that global fund, if you go to the next slide, you can see it's cost the fund quite a lot. So what's happened in the global fund? So the value trend fund is invested in the global fund about 20%. And so the look through, obviously you get on the global fund's underperformance passes through into the value trend fund or any of the multi-asset funds as a similar. I'm just using value trend. So global fund for the last year has been positioned for this surging US inflation, yields rising. So in that environment, your equities that are expensive are going to perform poorly. Your growth equities, your tech equities, your loss-making shares, your Russell 2000 going to underperform. But then your kind of non-cyclical value type of shares, your defensive shares are going to outperform. And so we've been positioned for that. And we've also been hedging our equity, which is costs. Obviously, when the market goes up, your hedges cost, and when the market falls, then they pay off. It's like insurance. So over the last year, barring the last couple of weeks, the trends have been almost the opposite of that. We've had the inflation, but the yields haven't really shot up. Tech shares, Russell 2000, loss-making shares, all sorts have performed really well. And your defensive shares haven't given you good returns, and equities broadly have performed, have had a really good year. So everything's kind of gone, the positioning has gone against us. And that's really, if you look through all the positions, that's what's caused the underperformance of the global fund. But importantly, we're not, get a lot of questions, you're just kind of shooting for some kind of binary outcome and hoping to get lucky. That's not kind of how we look at it. We look at this macro environment as a complex system. And as we look at the data, we're actually getting increased conviction. We're seeing the data match what our expectations are. And if we didn't see that, we would change our positioning. The timing is difficult, and we're not trying to time it perfectly. We're trying to manage that risk. But it's important that we would change our positioning if we changed our view. So that's the global fund underperformance. Something to point out is where you would have seen in the allocations of the funds, if we've had a very low equity exposure in the multi-asset funds. And then you say, okay, well, where'd the return come from? Because equities have performed well. So the return's been a bit lackluster recently because we've had banks which have done well, South African banks, but where we have taken our biggest kind of risk exposure traditionally would be your mining shares, and where we've taken risk has been in PGM miners. And this is just the PGM index versus the ALSI here over the last, so it's year to date. And you can see this chip shortage has caught us by surprise. We called it wrong. We underestimated the chip shortage and the production shortfalls. And that's meant that the PGM miners have underperformed as the commodity prices have come down. And so we had some losses on those investments where we were taking risk, even though the market has performed fairly well. It's been something specific to the funds. And so that's been one of the drawdowns. And then if you just go to the next slide, Rob, the other thing that happened, there was a bit of leakage of return. So we get a lot of questions saying, well, if I add up your exposure and I multiply it by the return, I don't get the same numbers. And so it's a small quantum, but all the pieces of the puzzle add together. What happened through the looting or the attempted insurrection, whatever you want to call it, I've got it there on the left-hand side of the circle, just some SA Inc. type total return proxies. You can see during the looting, so Monday the 12th, there was the first day, there was a little bit of a drawdown and then a bit of a recovery, right? It hadn't resolved yet. We didn't know how this thing was going to resolve, but in the context of South Africa and the risk we're taking, there's this massive political risk at the time. SA Inc. shares or exposure was down 1% or 2%. We're looking at this saying, hang on, the risks are asymmetrical to the downside. You could lose a lot of money if this doesn't resolve nicely. Obviously, your base case is things resolve, but that probability if they don't and the massive loss you'd incur. So we stepped to the side. We pulled out of some of these SA Inc. exposures that we were in the multi-asset funds. So we had bonds, we had a bit more rands than normal, and we had banks. And we waited for the situation to resolve. And so over that period where we stepped out, there was a bit of return leakage. And that also impacts the return, the total return of the fund, and why, I referred to why the equity returns maybe a little bit lower contribution than you might expect. And then if we just go to the next slide, just to kind of think about, is the team working? Are we lost the plots? Are we just picking shares badly and everything we touch falls? Importantly, the answer's no as we drill down into the data. So you can see here, this is the local growth assets, so kind of equities, commodities, property in the fund. That's the red bar, the carve-out return versus the all-share return. You've got to be careful looking at these charts because carve-out returns kind of blow up because it reweights everything to 100%. So just word of warning on it. But the point being, if you look at the red bars versus the blue bars, our stock picking has been pretty good. The drag on the performance just been we haven't had enough of it. If we had just had a much higher allocation to equity, but it's not that we're not picking equities well. And you can kind of see that as well in the equity fund returns, which I'll come to next. But I'm sure a lot of people have seen this chart where you can see that red part is the equity allocation is low. So we're sitting out of the market. We think the risks are high. We think the inflation risks are going to cause a big correction, and so we don't want to be there when it happens. We don't know exactly when it's going to happen, and that's been this big drag on performance within the fund. But the red portion, the equity that we do own, other than those PGMs, just kind of stepping aside during the looting, have generally performed reasonably well. We haven't kind of picked something that's failed or tanked. And the team's working nicely. I mean, this is our equity fund. We've spoken about it a lot. I think the performance speaks for itself. Fully invested, so there's no asset allocation call here for cash versus equities, and the team's performing well. We're picking good equities, and we're calling kind of the macro reasonably well. The events are playing out. We've de-risked the fund, so we've dropped the beta. We stayed in equities. We've dropped the beta a lot over the last kind of 3 to 6 months. We've had a lot of mining shares. We hardly have any mining exposure anymore, and the fund's performing really nicely. The team's performing nicely, so we're pretty happy with that. And you can see kind of on a risk return scatter plot. There's our equity fund versus peers in South Africa. And you can see that the fund's outperforming nicely on a risk adjusted basis. Most funds kind of shift along the risk return spectrum. But we manage that risk actively, and it's performing nicely for our clients. You can put it on the 3-year as well. And it looks on the next slide, it looks fairly similar. So I've tried to kind of cover the questions we've been getting. Obviously in the Q&A afterwards, please feel free to poke at it and question it. And we're really happy to take these questions. But I'll hand over to Rob for kind of the closing outlook and positioning.
So looking forward, I mean, obviously all we can do as investors is look forward. And while we think we're going to outperform from here, it's, I think, important to our clients. I think we're nicely positioned for it. The TINA trade by the dips is breaking down. Yields are rising in a meaningful way. QE USA version is ending, and the data is supporting our views now. We've got a chart or two on it. Where will the outperformance come from? Funds should outperform in a rising US yield environment. The Rezco global funds actually exposed about 30% of the fund as negative long bond, USA long bond exposure, which so in other words, if interest rates go up, the fund makes money. We're in an environment where value will outperform growth. We've got some hedged equity there, but as long as what hurts a little bit was the tech shares, global shares just keep pumping. That's turning nicely. And we think there's going to be you want to be defensive. It's hedged down. To just blindly say, look how good equities have been last year, I think it's going to really hurt. Broadly speaking, this is quite interesting, this picture, because you can see it's turned. This is a 30-year yield. Now, it's important the timing of this. So US yields have turned really as soon as the Fed said, oh, we're going to stop the QE. You can see that this is the 30-year yield started going up. If you looked at a very zoomed out thing, it's quite significant, the trend of that. The markets, oh my God, can actually also work out. There's no one left to buy the bonds. If you look at the S&P, so obviously a pain trade. We're with you in the pain trade. Actually, if you look at equities, the last quarter, they've done nothing, pretty much nothing. The last month, equities have been a horrible place to be. So we think the pain trade's kind of ending. Last quarter didn't work to be in equities. Gave you nothing. Last month is horrible. And that's important because that also ties in exactly where the Fed are being forced to recognize inflation. There's some possibility of inflation. If the Fed's got to be 100% sure there's no inflation to continue with their policies, and even they've moved to maybe not. If that maybe not, they have to get more neutral, stop QE, and actually talking about jacking up interest rates is what they're doing. And you can see that change in markets. So I think this year's been a pain trade, but it seems to be going now in our favor. It's a long-term track record that we have on the multi-asset funds. Obviously, equity funds only a 7-year track record, which has done incredibly well on choosing the particular equities. But on macro calls generally, we had a similar period coming out of GFC. We underperformed in 9 and 10 quite horribly, but then we're positioned for a boom. We think this massive QE is actually just extended this last rally. We think our view is most likely you're getting a nice 2000 sort of bear market, as we spoke in the presentation. So our clients trust us. We thank you for that support in doing that. In just being patient, I think its performance should be quite good going forward. So we've gone a little bit longer than we expected. I'll pass back to Brian a bit, and we can go in. For those who can stay around, as I said, we would love to hear all the questions. We will carry on chatting for as long as there's enough people on the presentation.
Thanks, Rob. Thanks, Simon. Excuse me. Just like we said in the beginning, we thank you for your time. We will be sending out a link to the recording if you did miss the beginning of the presentation, and a link to the slides, as well as a link to CPD certificates. We encourage you to stay online. I see there's still quite a few people. We've got quite a few questions which we're going to try and answer. And once again, thank you for your time. We appreciate it.
Great. So So we'll move to the Q&A. We've got a lot of questions here. Please keep them coming, especially questions on the performance. I try to cover everything there, but you might have something specific. Please feel free to scratch around. So this is the first question I want to answer. Someone asked about the low equity exposure and value chain. Firstly, apologies, I misread it while trying to do two things at once. So I answered horribly the first time I deleted it, but a very important question, because we do get this question a lot. How do you use value chain? So the CESA category is a high equity category, and that category has maximum equity limit, but it doesn't have a minimum, right? So for most funds in the category, they have a high equity allocation, and then they have a band around that equity allocation that they'll shift to be a bit underweight or a bit overweight, that like kind of long-term equity allocation. We don't do that. That's not the product that we do. So we have active asset allocation, and we'll use the 0% boundary as we see necessary. So our product is different. So if you think our product's the same as the other funds in the category, then we need to do probably a better job at trying to explain exactly what we're trying to do. So what we're trying to do is we sit in the high equity category, and we'll use that upper limit when we think it's a good time to use it. But what we'll do differently, and everyone has a similar upper limit because it's obviously Reg 28, but what we do differently is to manage risk. In some cases, we'll drop the equity exposure substantially. And over time, this works. So if you look at the track record of the value trend fund since inception, if you put the long-term charts up there, Rob, while I'm talking, you can actually split the outperformance from the yellow line and the red line. You can split the outperformance from peers into two components: asset allocation and stock selection. And we hadn't done this exercise. We haven't done this exercise for a few months, but when we had done it prior, you roughly got about half the outperformance came from stock selection and half the outperformance came from asset allocation. So you can see the fund avoided the drawdown in the GFC. It avoided the drawdown in COVID. And so we have added a lot of value from very active asset allocation. So you'd use it as a fund that's different to the other funds, that doesn't correlate, a fund that has active asset allocation, a track record of getting it right, and hopefully it would perform differently. Should other funds have a big drawdown, hopefully we'd get it right and maybe avoid that drawdown. And so within a portfolio of multiple funds, it would then add a lot of value through the risk management, while still getting pretty good long-term returns within the fund. So you get the risk management, and long-term you get the returns.
If I can just chip in there, I see can you hear me, Simon? I see my video might have frozen.
Your video is frozen, but your audio is clear.
Okay, so I'm going to kill my video and put it back on again, because I think I might have a horrible look on my face. Okay, for whatever reason, my video seems to have disappeared completely. I haven't left the meeting, but funds people use are funding in correlation. Our correlation numbers are very low relative to our peers. It's very important. It's normally a slide we put up, exceptionally low, because I think we're the only ones who sort of try to do that. So where you use value trend is in combination with some other great multi-asset funds. And there's a lot of good multi-asset funds out there. And you have 4 funds, and one of which is Rezco. And you get a better risk return, because we can tend to do badly. The market does certain things. We don't claim to, we don't know all the answers. We don't even know all the questions, but we've got a good record of getting the return, but at a different time. So when you put up a correlation numbers, exceptionally low correlation to the other funds. And that's where we are best used. I think where's wrong to use us is you put everything in when we've had a good time of performance, and then get concerned when there's we obviously want to perform every year. We don't want variation in performance, but we fit in well with other funds. That's where you get the best solution for your clients.
And maybe just one last point, because I think it's important. So thanks for the question. You'll see that our total risk is lower, but our relative risk, so how we perform relative to the market or others, has more variance to it. So I think, Rob, there's actually a little data table after the thank you with the risk metrics for value trend fund soon after the thank you, that little data table. Yeah, so you can see our risk metrics are lower, but our lots of good funds. So normally we blank them out, but they're all doing, a lot of them are doing really well. So happy, so you can see we get good risk metrics. and total risk, but the relative, the fund performance relative to other funds, there's a lot of noise there. You've just got to kind of understand the product is going to do that. It's going to perform very differently. So some people see that as a risk. They say, okay, the fund's performing very differently to other funds. That's too risky. I don't want that in my portfolio. And if you do see it as a risk, it's not going to work for you. But if you see total risk, the risk of losing money and so forth, that's the big risk, then it is going to help a lot in your portfolios.
So you can see the maximum drawdown is very, very low. The beta relative to the market is 0.2, whereas most of our peers are 0.7, 0.6. Standard deviation of the return, the variation of the return is low. Return at the moment, our 3-year, we've dropped below, but we over time have been better than most of our peers. But here's a point: you combine it. Most of them are, if you want to say asset allocation mistake, is sometimes you're a bit too conservative too soon, and we can accept that criticism. But now is definitely not the time. Now you should be adding, given what we believe the case of the market, we think you should actually be adding to conservative allocation. You want to combine this with some, and there's a couple of other good funds out there. We've just taken a sample of some of the big ones. So that combines really well with these because of what we haven't gotten here is a correlation with the other good funds out there, which is where it fits in well.
Okay, then just to maybe change tack a little bit. Good question from Jared Brittany. Are you holding out to the PGMs waiting for car production recovery? So at the moment, Jared, good question. No, we're not. We actually sold the PGMs. You saw that chart where the PGM price had come down quite a lot. We sold out before. We didn't kind of chase them all the way to the bottom. So we sold out before. So we redid our numbers. We recalibrated our models. So I said we were caught wrong-footed. We didn't call the chip shortage as extreme as has happened. But when we did get the new information, we recalibrated our models and we sold out of the PGMs and they carried on falling afterwards. So we avoided some losses. There's potential to maybe buy back in, but we want to see how these supply chains, this just in time, I mean, we didn't go into the presentation, but this kind of fragility of global supply chains is interesting. You kind of get this butterfly effect kind of through these supply chains, which stoppages, and then this stoppage causes another stoppage. And how do you kind of get the heartbeat going again? So we want to kind of see how that plays out. For example, the silicon price up 300%, that silicon metal's used in engine blocks as an example. So, I don't know, but maybe there's going to be an engine block shortage at some point, which obviously, could cause production issues in the future. So we want to kind of see how that plays out. And there's really good commodity opportunities at the moment. We're in, in the local fund and the global fund, we're in kind of coal, aluminium, uranium, some kind of the green aluminium, made from hydro. There's some good opportunities in the space. So we've got some exposure to commodities, but not very, very little, tiny sliver in PGMs at the moment. Okay, so there's a question from Paul Fichet. What would you need to see unfolding in order to change your view? To be fair, you did send that question before we had the conclusion slide, but just to reiterate, Paul, we're seeing it unfolding. So some of the slides, you'll see the heading was the risks are in motion, or we're seeing it unfolding now. We need this trend to continue, basically, but we are seeing it unfolding the way that we expected. So equities down, yields up, expensive growth tech shares down, kind of non-cyclical, more value-ish, kind of yield beneficiaries like banks outperforming in this environment. We're seeing those mechanics work in the global markets. The local market's interesting because we had that slide, we seem to just be tracking the global sentiment. Our local shares, it's a big debate we're having internally as well. Is there a good story in South Africa, or is there just a good global story and we're going for the ride? It seems more like there's a good global story and we're going along for the ride than we actually have really good, a good structural story in South Africa. Now, it's always difficult because when there's good things happening globally, when the feeling is good, you highlight all the good news locally. If the global news was bad and equities were down, you'd probably see the media highlighting all the bad news. So this kind of schizophrenic nature of markets where you only see the good news and then you only see the bad news. I think that's a little bit what's happening in South Africa at the moment. There is good news. There's stuff that we really like and we're tracking and there's opportunities. But the reality is there isn't really that structural GDP growth that you'd need for an upward trending kind of compounding environment that's really nice for local equities. So we're not seeing that. So our view's kind of playing out over the last few weeks, very early few weeks, it's very early, but the point is it's backed by data. So those yields went up on the Fed's September meeting and the information and the kind of press conference afterwards and so forth. So the moves are backed by kind of data that's unfolding in the way that we expect, which gives us confidence that we hope that it can continue. Okay, just a question on the equity fund. So if the market crashes, is the equity fund set up to match the defensive nature of the other funds considering the full equity exposure? So it's a good question. So the equity fund's fully invested, but we've de-risked it. What do we mean by that? Obviously, we're staying in equities, but we've got some really good tools in that we use to kind of calculate a forecast, so a forward-looking risk metric. So it's called X anti-beta. It's not so you normally look at a historic beta. You take a covariance table, how everything kind of blends together, and then you forecast the future beta, how that will respond relative to, say, the JSE top 40. And we also can do the same thing for volatility of the fund. You can do it for risk factors and so forth. So what we've done is we've constructed the portfolio in a way that to reduce our beta substantially, reduce our forecast volatility, reduce kind of factor exposure that we're worried about. And so we had hoped that if we write and the market has a big correction, we'd have a much smaller drawdown on the equity fund. You can't avoid that. If you try and avoid it, you're probably gonna make some big mistakes. You just want to kind of take the hit as well as you can. You want to brace for it. And so that's what we've done in the equity fund. So hence why we've reduced the mining exposure. We've reduced exposure to China as well. Things like that are important for the equity fund. Anything that's kind of got a high gearing to kind of global sentiment and growth, we've reduced exposure. We're kind of in more defensive type of names within the fund.
The standard deviation, so it's the lower the volatility of the return. But if you track it, the beta, the forward-looking beta will correlate now reasonably well with standard deviation. Now these are always approximate. There's no, you can't just close your eyes on these things in terms of risk. But in short, what Simon's done, we've built some very sophisticated tools with our tech. We monitor very, very closely. We've dropped the beta, the X anti-beta down to about 0.7 in this fund. We're classically on finance. If the market falls by 10%, we should fall by 7%. Now, it's never going to be absolutely like that, and these things, but there's a lot of ways we look at it. We forecast the standard deviation, but we swung the portfolio. It's 97% invested, but we would expect it would fall less if the market fell. Now, these are always historical, forward-looking beta, but it's still approximation and calculations. But that's how certain shares, like for example, our mining shares, if the market falls 1%, they're going to probably fall 1.5%. But that's not a rule like gravity. That's just based on past relationships and predicting going forward and how things. It gets very complicated calculations, but it does bear out in the reality, and we do that. It isn't by accident we've got this really low standard deviation. And the point what Simon was saying is, if you look, that most of the industry, and these are the SA only equity funds, they go along this line. A higher standard deviation, you get a higher return, whereas we deliberately manage to try to get the standard deviation down. And we use it, the volatility of predicted volatility and predicted beta, and then just our own logic too. You've always got to use your brain in this game. What big risks are out there? What big themes are out there that could be risk vectors?
And then Mark Liddy's actually got a great question. Nice to talk to on this essay. Mark, I think you're talking about South Africa. How will the drop in commodities affect the fiscal position? So the thing about, we talk a lot about macro and the complexity of it, but it's a good question because it's this kind of system, and there's repercussions and flows and effects and so forth. So in South Africa, what's gone well for South Africa? Global growth and shortages. We produce commodities which the world is short of, okay? And the commodity prices pumped up. That created a trade surplus, which strengthened the rand. And also at the same time, ended up South Africa had a current account surplus, but also the mining companies here had super profits, and there's these huge tax collections. So this beautiful self-fulfilling kind of loop that was working on a risk-on environment. Okay, then what happened? China. Firstly, they said, we don't want to pay so much for iron ore. Also, we're polluting the country. Don't have enough electricity. We might as well cut steel production, aluminium production, and so forth. Plus, there's this property issue. And now you've got kind of global inflation risks and the concern around this, the cycle ending. So what happens? Commodity prices come down. Commodity prices come down in a risk-off environment, and the rand weakens. The trade surplus goes towards the deficit line, not there yet. The tax receipts looking forward look a lot worse, and this whole thing unwinds because it wasn't based on internal reform in the country. It was based on an externality of the global growth environment and shortages, which was we're benefiting from and was great, but wasn't sustainable. I mean, the key thing when running a country is to take those windfalls and turn them into long-term gains. Hopefully, maybe there's still some opportunity there. But the fiscal position, yes, is impacted. Commodity prices come down, and the kind of benefit to all your SA Inc. exposure reduces, right? So obviously it'll take time, but your kind of local local South African economy exposures, right, like your retailers and your banks and that, will perform a lot worse than expected in an environment where there's low commodity prices, because South Africa as a country is doing worse. And that's, so it kind of goes through the whole system. So it's a good question. And that's something that we position for now. So in the equity fund, we were positioned for the commodity, and the fund did well off commodities and mining shares, but we've removed that kind of that positioning, except for kind of commodities where we see some big shortages because of China, where they're kind of like aluminium or coal or things like that, where there could still be opportunities. Okay, so we're getting a few questions here on the bond exposure and value trend fund. So it's a good question. So Alan, I think there was another question. There's quite a few here that I'm trying to get to. But Alan, bonds look like they're the most vulnerable assets. Yes, we agree, especially US bonds or kind of bonds with very, very low yields. So does this increase the risk of value trend fund? There's a heavy weighting towards bonds. Okay, so it's an important question. So how we position for kind of a risk off inflation, rising yields, and so forth. But we get this kind of, in constructing the portfolio, we don't want to build the entire portfolio around that view. And in the value trend fund, what we do is we don't have the extreme duration. It's kind of around about the R186, so it's kind of 6-year to 10-year type of bonds, where we're sitting in bonds with some duration, right? But because the yields are so high on those bonds, the duration's a lot lower. So your durations there are much, because you're getting the sensitivity to interest rates is lower when you have a higher interest rate, right, on a bond. Whereas in US bonds, because the interest rates are so low, the sensitivity to changes in that interest rate, the duration is much higher. Okay, so when you can't just directly say translate the US bond experience to the South African bond. So just be careful of a 1-for-1, but the direction is the same. US yields go up, South African bond yields potentially match it, and that would cost you on your capital. But just bear in mind that when you're earning 8 or 9%, it could go 50 bips, 100 bips up on a big sell-off, because if US bonds sold, or if US bond yields went up 50 bips or 100 bips, that'd be a bond market crash, right? In South Africa, and because you're only earning 2, right? But in South Africa, if you're earning 8 or 9 and it goes up 50 bips or 100 bips, you do lose capital, but you're also getting the interest paying out over time. So within the value trend fund, so I'm going, hopefully this is making sense, Rob, jump in if I'm, but in the value trend fund, we broadly positioned for the macro risk we've been speaking about, but part of the portfolio construction is to include some risk assets, not zero risk assets. And the risk assets that we think is the best risk to take at the moment would be South African bonds that have got these kind of, not the extreme end of the duration. We think that's a reasonable risk to take. That being said, the position size is quite large, and if we get even more conviction, we might reduce that a little bit. But you want to sit in them to get the yield. The yield only matters if you stay in the bonds. You don't earn the yield if you can't trade them for the yield. You got to be holding them. So yes, that is a bit of a vulnerable asset, but it's the kind of one area of risk really within the fund left at the moment as our conviction has increased. I hope that answers the question, Rob. I don't know if you want to add.
Yeah, there's also an important point in so if you look at the overall asset exposure of Value Trend Fund, it obviously has it's a 20% invested in. It's got about it's 20% invested in the global fund, which obviously we don't charge a fee twice, which has about 1% exposure to negative 30-year duration. In short, the Value Trend looking through on our local funds, and we look through quite short US duration. Our local duration, the one risk to these funds, if the rand does strengthen. Now there's some case on that. We believe largely in a sell-off, the rand does weaken, and you've been seeing that the last month. On balance it does, but you want some counterweight. If there's some strengthening of the rand, then the bonds do well. So we don't want to be at 100% on our core view. So that, but a bit of the duration, tying on what Simon said, limited a risk thing there, balances out with the rand, which I think is the best risk reward at the moment. But we will reduce that if it looks like the market's sliding fast.
Yeah. And that kind of leads nicely into a couple of other questions. Ricky Williams just asking, so we think we could go into a nice period of outperformance now, but in a falling market, so Ricky's question, will that mean you still make money, or is it only losing less money than the peer group? Okay, so it's a good question because and our positioning at the moment, to Rob's point now, we think that in the local funds, assuming the rand weakens in the risk-off environment, our global funds are very well positioned for bonds yields going up in the US. So we've got short duration exposure, or negative duration effectively. We're not short.
We're short long duration. So you're going to get, in other words, it's got a short position, short of 30-year US government, 30 years. Yeah.
Exactly. So yields go up. That means prices fall, and if bond prices fall, the global fund makes money. Okay, simply put. It's obviously it's very well risk managed, but just simplistically, that's how it works. There's nothing complex, nothing fancy in that, but just the way that the bonds work. Okay, so the global fund would do well. We would expect, if our views are right, for the global fund to have positive dollar returns. So not fall less than the market. We'd expect positive. Now we're not aiming. You don't aim for 30%. We're not trying to take fancy, weird, geared derivative structures in the fund. That's not what we do. We're not kind of a high risk hedge fund, macro hedge fund. That's not what we're doing. But the way that we positioned is we'd get incremental, decent, but US dollar returns in the global fund. That would translate through, because the question's, I think, more towards the South African market, that would translate through into the Value Trend Fund. Assuming the rand weakens, that then would enhance that kind of 30% that's offshore. And locally, we have very little equity. We do have some bonds, but I don't think they can fall that much in price unless there's this huge catastrophe, in which case equity markets, South African rand would be smashed, equity markets would be smashed. Now, if you're talking, it's not our base case. If you're talking US yields, move 100 bips is 1%, right? 100 bips, this huge move. If that happened in a very short period, like 2 months, that would be a massive kind of bond market crash in the US. Something like that happened, it'd be a big event. You'd probably see, I'm not exactly sure how South African bonds would perform in that environment. It'd be a counteracting force to the global fund outperformance, the rand weakening, and it would detract a little bit from it. But I think we'd still end up with positive returns, but not huge positives. A very important thing on how we think about taking risk. So you've underperformed, we know that, but what you've got to be careful of is trying to get a massive return from a period from a period of underperformance. It's okay, we've underperformed, now we need to catch up in a month. That's very kind of short-sighted, and usually what happens if you try and aim for that, sorry, it's not the question, Ricky, I don't think you're implying it, but it's an important point. If you try and aim for kind of shoot the lights out recovery type returns, in 2 or 3 months we up 30% and all the underperformance is unwound, if you try and aim for that, chances are you miss, and that's dangerous. We very much risk focused, always forward-looking risk focused, and you'd rather just have good incremental adding to the performance in a positive way over time, just plugging away at it, and outperforming in that way. That's kind of what we're aiming for. But obviously, in a big market correction, we'd expect to outperform a lot in that environment. In a bear market where it's just trending downwards, we're trying to add small incremental positive returns.
We're looking for high single-digit returns in that environment of a smash up. Obviously, would be very, very significant outperformance relative to multi-asset high equity funds.
Yeah. And then just to talk about the Rand, Wessel Grobler has got a question. So the Rand was a big detraction in that waterfall chart we had up earlier. So we're not really speculating that much on the Rand. So the question is, how often can we expect a view expressed on currency within the portfolio value trend, mainly used to manage risk or exploit mispricing? Question mark. So Wessel, we mainly use currency in a kind of a global diversification risk management. We're not trying to kind of take a chance on calling the Rand. We do move it around a bit as part of our risk process. For example, like Rob mentioned earlier, we own South African bonds and we also have full offshore exposure. Now, those two kind of counteract. If we didn't own any South African bonds, it would be dangerous then to have 30% offshore, because if things resolve positively, the Rand would strengthen, the bonds would do well, SA Inc would do well, equities would go up, but we'd lose money on the currency, right? So in the context of a portfolio and risk management, we allocate with that up to 30% direct offshore. We allocate that on a kind of a risk view in the context of what else is in the fund. And we want to have kind of a globally fairly robust portfolio in these kind of risky environments. And in this case, it means having 30% offshore, but it doesn't have to be that way. It also depends what else is in the fund. Okay. We've still got lots of questions. There's still a lot of people on the call. I think it's important we go through these questions. I'm happy to carry on. I'm just kind of skating through to try to keep the thread of the conversation going. So I've been avoiding offshore questions, and there's quite a few offshore questions. So one that we get, here's one here. My concern is that the Fed will not react to inflation and not raise rates. Does this automatically mean that the bond market will do their job for them by falling? So it's a good question. Obviously, there's a context of QE here. So if the Fed stops QE, and we had that slide of who's buying bonds, US Treasury. So basically, who's funding the shortfall? It's been the Fed. So if there's inflation and the Fed doesn't react to it, does that mean that they continue with QE? Okay, so when you say don't react, so not raise rates, fine, but do they carry on with QE? If they stop QE, so there's inflation, they stop QE, but they don't raise rates, yes, I think the bond market does their job. That's a big enough, liquid enough, sophisticated enough market, and it's bigger than the Fed. It's substantially bigger than the Fed. If the bond market moves, the Fed will be kind of a smaller player in that boxing match, and so the Fed would probably lose. So the Fed has to keep credibility. It has to stay convincing. It has to feel like it's on top of inflation, and to do so, it would then have to react. No one's going to believe the Fed if there's inflation. Bond yields are going up, maybe slowly, and the Fed says, no, don't worry, it self-reverts. So you saw some of those quotes, and you'll see comments from Fed officials like, it'll go back to 2% on its own. We're not so convinced, and I don't think the market is. And if in that environment, when there's even more inflation, if you keep on saying it'll go back on its own, don't worry about it, you lose credibility. The market, I think the bond market will do its job. It's already kind of doing its job, and the Fed's still buying. And these yields have gone up, and the Fed's still 75% buyers. And one other point on the bond market, which I don't think we mentioned on the slide, but which is important, is so okay, well, there's still other buyers, right? The bond market's very strong, yields haven't gone up, there's still other buyers. Those other buyers are almost forced buyers. So it's like banks and insurers and foreign countries that have a current account surplus, things like that, where they have to buy something. And so they become the buyer, but they're not going to be the marginal buyer. Prices are set by the marginal buyer, the marginal seller. They're at 25% of net new insurance, right? Funding it. The other 75% needs to be replaced. The people that have to buy are already buying, and they currently the marginal buyer because the Fed's kind of the base, right? And an insurer is going to buy no matter the yield. The actuaries will just do their normal asset liability matching. They buy, that's their job. As the money comes in, they buy, right? That there does not hold up the market, and that is already in the base. the Fed coming out is a big problem. It'll be interesting to see how it plays out. It'll also be interesting to see in the context of, historically, China has been a big funder, China and Japan, been big funders of the US budget deficits, whereas now this kind of supply chain bottlenecks, the ripple effects, China slowing down, the energy issues, the liquidity issues in Chinese property, who's going to be the new funder of the US budget?
I
don't think it's going to be households.
That's foreigners edge, and the biggest parts of that are China and Japan. That as you can see, since 29, it hasn't really going up much. So the net incremental bar has been the Fed, and it comes back to one of the concerns of bond vigilantes. So as long as the Fed are buying 70% of the deficit, it works. But as soon as they got to stop, and that's the first leg. The Fed have had to stop because inflation is certainly, it is not 100% chance there's no inflation. They're getting to it's 50-50. And that's why the market's rolling over, because who's going to buy that now?
Okay. I'm just kind of scanning through the questions here. So just on inflation, just another question. Do you think it's going to become entrenched 1970s style? It's important, like economists and commentators, we're always trying to find something in the past which looks like we think the future will look like, because we can get our heads around it. I think something that's dangerous about these comparisons is the state of the world now versus the state of the world then, right? In this environment, you've currently got 0% interest rates, you're printing money, okay, you're handing it out, you've got these massive shortages in a very strong economy, and you're much more indebted, both corporately and also as a country. So the inflation that was disruptive in the 70s was much more substantial than what would be required in the current environment to be disruptive. In this environment, 3% inflation is disruptive. You don't need 10 or some big number that might have been reached in the past, because in the current environment, interest rates are at zero. They weren't at zero in the 1970s, right? So that's an important distinction. So we don't think that you need this kind of entrenched, massive kind of getting out of control every year, just going higher type inflation numbers to destabilize the current environment, because equities, as we said, are expensive and priced for high earnings growth, high economic growth, high margins, and an environment of 3% inflation. If it doesn't come under control, what do interest rates have to go to in order to get it under control?
If I can just, there's the blue line, there's inflation. You can, prior to in the 60s, it was actually reasonably well controlled. The blue line's inflation and the red line's 3-month interest rate, short-term interest rate. So you can see they sort of track each other. And that's great. Here's a period of inflation. The CPI went up, it was very bad for equity markets, only went up to 6%, which not much higher than it is now. Just FYI that then there was this major acceleration into the sort of mid-70s, went up to 12. So 2 points. Firstly, the jump up to 6 smashed the equity market there. We're not forecasting 12, but here's the problem. If you can see the blue line and the red line, CPI and inflation kind of track each other. So you can't have interest rates too negative. Now, TINA is based on something illogical. Look where the blue line is. And even on slightly 4, because it comes back to 3. TINA is based on the assumption that the red line, in other words, short-term interest rates, can stay forever. And that we think is la-la land. Expecting very expensive equity markets, to just keep on going up based on this disconnect where the inflation is and the short-term interest rates. Now, if interest rates just normalize, which would get back to your kind of 2% level, and now bearing in mind that took a long time here because it's very slow coming out of the Great Recession, but it should be with inflation at 2, which is normalized sort of inflation. The target interest rate should be about 2, because a negative interest rate is very stimulatory. So in other words, you're making the problem bigger and bigger, and that's the disconnect on TINA, which you can see really clearly here. Inflation doesn't have to be 8% for this market. It's sitting up here. That's the earnings yield super down here. You can see similar to 2000 levels. This is justified by you've got an alternative because interest rates are zero. But for that to happen, interest rates are going to stay at zero or very low. And that's what we're saying, there's a disconnect here. Even if inflation stuck at 2.5%, 3%, the Fed have to go to neutral. Neutral means no QE and about a 2% interest rate. And the market is just, that means TINA's, there is an alternative to equities. There's got to be a repricing. If the Fed are behind the curve and they're going to slam on the brakes, then you've got something far worse.
There's still kind of over 100 people on the call, and as we see, we like taking these questions. We'll keep going. Hopefully,
yeah, feel free if you have
useful.
to go. We once had a criticism from someone, but I think they had their sound off and they were doing something else. But like you said, a 1 hour presentation and it went on for 1.5. The CPD points, all of that set up based on ending the call at after all the 1 hour. So this is our coffee time after the presentation if we reference it. So feel free to keep chatting. But if you need to go, don't blame us for talking about it. We love this stuff. We love talking about it. So we're happy to keep talking. If you think we're killing your hour, yeah, it's not the intention. We're assuming there's still 120 people on the call because they're interested in the answers and want to carry on chatting.
So important thing on this kind of risk management, time in the market, there's a question here. Can we not say all these views, Tina, our view, and so forth, can they not all play out at the same time but over different time horizons? How long can Tina go on before our view plays out? So the question then is on the opportunity cost of being significantly early. If the market continues to be irrational for long, how will this impact your investment views in Rezco as a business? Okay, so it's a good question because we've always said risk management, not market timing. And that's because we don't think you can get market timing exactly right. So you can call the risks, you can position for those risks, and then if you do that on an iterative basis, you do it over and over again. If you kind of get the probabilities right over time, you get a great long-term track record. Okay, and that's what we're trying to achieve in the fund. We're not trying to sell just before the market crashes because that kind of thing. If you wait for the last dance, you get stuck, right? So can they all kind of play out the opportunity cost? I think that's an important question, but you can flip it on its head. Is the idea that you should stay invested implies that you've got a high confidence that over the long term the market will always be up. So if you lose money, you'll get it back again. If you think the market you could lose money over a 3, 4, 5 year period, like a horrible bear market, like off the .com. I mean, .com was this horrible multi-year, and then it recovered into the GFC, then crashed again, then recovered. So you had this very long period of not making positive returns, right? In those situations, yes, I think the opportunity cost is worth it. So kind of, is it worth sitting out the market when you're missing out on such good returns? And don't forget, the higher the opportunity cost, assuming we're right, okay, which isn't guaranteed, assuming we're right, the higher the opportunity cost, i.e. the more the market goes up, the bigger the risk, right? It becomes this kind of the tension in the system builds and builds and builds. If it blows kind of harder if the market's gone up more irrationally. But that's assuming we're right, that this thing isn't kind of built on solid foundations. And we think we are. We've got conviction. We've done the work, but it's never guaranteed, right? And so in that case, yes, the opportunity cost is worth it because we don't think that most of this year-to-date rally, most of it hasn't been justified because you've got inflation, interest rates have to go up. They should be up already. The QE should have stopped already. It hasn't. We've been surprised at how long it's taken. We wouldn't have, if you gave us all the macroeconomic data and then asked us, at the beginning of the year, you gave us all the macroeconomic data up to end of September, and then said, okay, predict what the Fed will do and say, I would have got that horribly wrong. Give me that macro data. I would have looked at that and said, sheesh, the Fed's definitely going to be, you're just taking the foot off the gas by mid-year on these numbers. Markets pumping.
I mean, I'll sort of view it's an important point Sam's making there is, look, if inflation's 3% based on every prior behavior of the Fed, if you take these relationships you're taking, the Fed should start reducing the QE, and we think we're going to be right. There's going to be some inflation, not go through the roof. Inflation will start ticking up, the Fed will react. Now, that would you expect middle of the year? They didn't, but that just makes it more likely that now, oh my gosh, there's been more inflation than we expected. A lot of prominent, very clever people like Larry Summers, like Jamie Dimon, tell you you're going to get inflation, guys. They chose to believe their word, but the reaction 3's fine, 4's fine, 5's fine, but the Fed's now got this behind the curve-ish feel, which means, you know, it's become a bit of a pain trade. They should have reacted earlier, and the problem's getting worse. If we felt it was going the other way, then we would obviously react to change of positioning. But it's been a strange concept in the Fed. Really, it's driven by US politics. I don't know if anyone follows US politics much, how absolutely politicized it's become, ideologized. It become ideological. Sorry, I messed that word up badly. It's not what the facts are, it's based on something other than economics, on the whole, the Fed thing, on the economic discourse. And that's the strange thing. That's what certainly surprised us a bit, but the economic realities haven't changed. And that's getting bigger and bigger. So for us, it's you keep checking the facts. If the facts are saying something different, change of positioning. But we fit in a good place with our, on our clients' portfolios because we combine well with those other funds. So most multi-asset funds are going to keep their equity exposure at 65, 70%, even at the moment. So if this thing comes unstuck, then everything goes down together. We the shock absorber in the system. And the facts seem to be adding up that we're getting more right, not less right on it.
Okay, great. I see Clem, I hope he's on the call. I see you asked some questions in the Q&A, and then you've also asked a question in the chat. I'll just try and address those. Thanks for the questions. So yes, so kind of we apply a very active asset allocation in our funds, and those are the multi-asset funds. So the stable fund, the managed plus value trend fund, and the global fund are all kind of multi-asset with a very kind of high active components. So we move the asset allocation around. We've got the chart here for value trend, but you'll see similar story. So you're right, we do, and it's very different to peers. Our product is different, and it should be used accordingly. And hopefully we're getting that across. And then there's a high position in bonds, but we're cautious on bonds. So you're asking that question, did I see correctly? Yes, you did see correctly, Clem. Obviously the duration of that portfolio, so how much interest rate sensitivity it has is important, because everything's called a bond, whether it's got a 30-year term or a 3-year term, it's still called a bond, right? So the interest rate sensitivity of that portfolio is important. Now in the value trend fund, we do have some interest rate sensitive bonds. There is a reasonably large position in that. And the reason is it's in the context. We haven't positioned just for, putting the entire portfolio onto one view. We acknowledge that the timing's difficult, we could get things wrong. And so we think that the idea of having South African bonds with a good yield, with very low equity, maximum offshore, so that 30% allowance offshore, and then globally having negative duration, right? So for the fund, it's this fund that you see here on the slide, it has 20% in the global fund, and the global fund would benefit from rates going up because it's got a negative exposure to bond prices. Okay, so that would pass through into the value trend fund and compensate partially, should yields go up a lot in South Africa. And so that's important, is when we put all the pieces together, we think that makes a good portfolio built primarily for our base view, but also we want to get some return if we're wrong. We don't want to kind of, if we're wrong, that means the rand strengthens, we lose a lot of kind of translation on that kind of global exposure in the fund. We'd need some compensating factor, which would be then your local bonds. We've positioned it like that. So I hope that's clear, and I've answered the Q&A one and the chat. And that we obviously want to claim thanks. We obviously, I think you said that just before we started going through, the underperformance. But there was another question on the underperformance, which I just want to jump to. It was a good question about, we seem to be calling South Africa right and global wrong. It was a good question. So we seem to be calling local equity fine. Fine. I'd probably say well. The fund's doing well. We're calling local equity well, but we're calling global equities incorrectly. Now, can we just kind of talk about that a bit? It's a good question. All right. So in our fully invested strategy, the equity fund, the performance is good, and we have been very active in that fund. We've been moving the risk around in that fund, and it's a very different product. Now, it has been positioned on the same macro views as the other funds, but just expressed through through a different strategy. Okay, so the view's the same. The equity fund's isn't positioned around TINA or something. The positioning of the equity fund is the same macro view as the other funds, but it's obviously expressed differently because it's a different product. What people use that fund as a building block. It needs to stay fully invested at all times, but the shares that we pick match that view. So to some degree, the performance of it represents us getting our view right in a macro perspective. Okay, but the disconnect has just been that although we've kind of been calling the macro reasonably well, that macro view hasn't translated into equity levels the way we thought it would have. Okay, so in the fully invested strategy, the equity level, we're not making a call on necessarily on the equity levels, we're just picking the shares. We would have thought that our macro view would have meant drawdowns in equities. So we that's one of the reasons the equity fund has done well, is that our macro view, we've been playing shortages, we've been playing inflation, we've been playing a lot of the kind of themes that we've been talking about, but expressed through equities. And then the other funds, we've expressed it through asset allocation primarily. And the equity market levels have just not done what we thought that they would have done in this environment. So that's the disconnect. It's not like all the skill sets in the equity fund and then we useless in the global fund. If we had a minimum invested allocation in the global fund, our stock picks have actually been fairly decent on the long equity side. We haven't done badly there. It's just that we haven't taken exposure to the market. We've kind of hedged it by shorting the index. We've had very low exposure and so forth. But our mining exposure in the global fund has done very well. It's outperformed substantially. Some of our stock picks there have been very good. There's been a few mistakes, like I said, PGMs and the platinum miners, which haven't done well recently, and so forth. But I don't think there's this massive like it's two different teams running the funds. Okay. Okay, I think we hopefully covered a lot of them. Obviously, there's a whole bunch of questions. I mean, there were a few hundred people on the call, so you can imagine my Q&A little tab here. I'm trying to make sure we broadly cover everything. I think maybe for one last question, I guess, gold. It's Alan. Let's just talk a little bit about gold.
Yeah, I'll jump on gold.
Why not?
Gold's always,
do you want to do gold, Rob?
Many years. Gold's an interesting one. Theoretically, gold should be in a position to really fly because you have all this printing of money around the world. There's massive just printing paper money with no, so you would expect over time gold people to say, well, I'm not prepared to accept a US dollar where the Fed are just being irresponsible and just printing trillions of these things out of thin air. So if it was a foreign government, I would hold gold. And you get in an argument if China ever got into an argument with the US, do you want to be owning your reserves in treasuries? And we expect that trend will play out, and we're looking at it. At the moment, however, gold has got a very close link to US interest rates. If you look at the treasury protected, inflation protected treasuries, there's a horrible correlation there with gold. In other words, if interest rates go up, which is our core view, it's tough for gold. We think that will break in this environment, but shorter term, you've got to be a little bit nervous of that. So primary view is interest rates go up. That seems most likely given the stack. Gold, you want to see two things: funds starting to buy gold, physical gold ETFs, and that link on a graph with a 5-year tips breaking down. And then that gives gold, because also can gold go up in an environment where US interest rates are going up, bond rates. And gold's ultimately a momentum asset. Gold's a bit like Bitcoin, it goes up because it's going up. You'd be very careful of having too much of a theory. So if gold starts going up nicely in an environment where US bond interest rates, say the 10 years going up, then it changes the sentiment and you start to see fund buyers buying gold. Then gold can have a good rally, but you've got to have a bit of a wait and see on that. We bought a little bit in our equity fund, first time in a while to get a bit of gold, but it's like 2-3%. Really, just foot in the door, thinking about it. It's probably obvious it's too early to make a major call on it, and let the facts play out a little bit.
Yeah. So I think that's good. There are some questions which we haven't answered, and some of them are some good questions there. But I think broadly we've covered a lot of the topics. And feel free to shoot through some questions. There's some data requests that I see coming through as well. Feel free to shoot them through. It's easier afterwards just to send an email or so forth. We're very, very happy to have the conversation as needed. But I'll hand it over back to Rob for closing comments.
Yeah, and we love to get on a call. It's the one advantage with everyone is pretty set up for video calls. So the sales guy Brian and his team, if there's a kind of chat through that you want to chat to myself and Simon, we love to do that. I mean, I think we often get responses that our PMs are more accessible than some of our competitors. We like it because we like the interaction. And we'd often much rather you asked us the question in the room, the elephant in the room question, then you didn't ask it. Like, what, you've got a particularly harsh question that you want to ask, because it's very serious stuff that we're doing. We're happy to do that. And we feel we've got decently good answers, and we often find the interaction with the clients. Oh, okay, I understand clearly what you're doing, and that gives me a great level of comfort. I had one with a client where you got on, they're very scratchy, or it was a global fund, haven't performed well, got on the clients. Well, actually, the advisory got on with the client, and it's, I can understand what you're doing. Actually, I'm going to allocate more to the strategy. And we like those interactions. We don't have, as I said earlier, we don't have all the answers, but we think, we know we think slightly differently, and we like the questions, and it's great to get on the call with you. It's one of the harsh things of this COVID, not seeing our clients, and so sometimes the next best thing is getting on a call, chat to Brian, the sales guys. We can set that up with you, myself or Simon, quite easily. Brian, I don't know if you want to close the thing, if you're still there.
Thanks, Rob. Sorry, my email address, I did put it in the chat box, brian@rezco.co.za. Please feel free to email us any additional questions that you may have, and we'll answer those and send you the response. But thanks very much.
Great. Thank you to everyone. Thanks for your time coming on. Really appreciate it.
Thank you. Cheers.